If you asked anybody out there right now whether they're bullish or bearish on markets, the predominant answer is going to be bullish. But is that the right call for the next 5 days? In today's video, we take a look at what the advanced decline line is telling us about markets, how we've filled gaps across the board, and why the 2-hour 20 moving average could be one of the most important indicators over the next few sessions. Join us as we go through the stocks, the cryptos, and of course the commodities to find the opportunities right now in these markets. Well, welcome back everybody to the Daily Show. My name's Tom, and in today's video, we need to talk about markets right now because there are some interesting things occurring. In particular, the weakness that we've started to see in certain sectors over the last 24 hours may suggest that things are about to turn towards the negative side for the first time in 2 weeks. Yes, S&P 500 forward returns when we've had the 8 days up tend to look a little bit poor for the next 5 days. And if you know anything about your stats, you would know that generally over a 5-day period, markets are up. Well, in this case, according to Grant Hawkridge's data, the positive percentage is only 44.6% of the time. And that continues through to 10 days and 21 days, where we tend to see a little bit of up, down, and all around style market conditions. So could things actually be about to slow down? Well, there are some bullish kind of cases here that have come up. In particular, the Zweig breadth thrust is at it again, with Ryan Dietrich over on X saying now we've triggered another Zweig breadth thrust. Now, there are 2 ways to calculate this, but we do know that it's a very bullish statistic overall, and it does tend to lead into some significant gains, in particular over the 12-month return. Now, according to my data anyway, we haven't quite hit the Zweig breadth thrust thresholds, so I've checked with a few other people on X, and most of us are seeing reads like this. It is an interesting point, but I would take it with a grain of salt. Remember, we already have a lot of bullish signs when it comes to the next 6 and 9 months. So it's just one that you could, I guess, you put into the consideration when you think about it. How does market really react in October and August and September though? Well, one of the things we know is that August can be kind of weak, but when we have a bad start to August, often it does come through with the goods. And really what we should be looking for more when it comes to weakness is the back end of September. Whatever we see here might be short-lived. Let's say we get a gap fill and then the markets start to rebound. Well, that seems to be the most likely thing on the cards. Remember, for anyone that doesn't know, about 3 videos ago, we discussed the idea that we're in a buyback period, a point in time where we basically see stocks being purchased by companies around the world, and in particular, the US, of course, is buying heavily at 5 billion plus. To put on top of that, we've also seen commodity trade advisors, CTAs, also start to have to buy back in because they were left behind. So all of these things are starting to force this market up, and it's been one of the reasons why we've seen such an aggressive thrust. In light of the Jackson Hole Symposium this week, these are the moves in terms of the impact on the 2-year yields from the previous kind of 4 or 5 overall examples. And you'll notice here when it comes to the FOMC meeting speech by Jerome Powell, he will move it a little bit when it comes to rates. In terms of the stats around the Jackson Hole, I would say that we don't have any clear indication of exactly what happens unless Jerome Powell doesn't attend. When we've seen previous Fed chairmen not attend the event, both have been negative. Global liquidity index, something we talk about a little bit here, has started to improve. And remember, this is all in line with the cycle. So considering we've got a 70 breadth thrust only a month ago, a Whaley breadth thrust, and now possibility of a Zweig breadth thrust, all of those things were kind of leading towards you've got to remain a little bit bullish here in what we call late cycle investing. Now, that is, of course, if you're looking at a market from a multi-month approach. If you're trying to day trade it, we are certainly at a critical resistance, which we'll go into in a moment, along with the options flow. What does the options flow tell us? When it comes to some other data stats, when we start a new bull market, arguably we entered from a technical bear market to a technical bull market starting in October of 2022, we tend to see a percentage change on average of around 91%. Now, we're only at 61.3%. So if you take this into consideration, yeah, we may have a little bit more to go. And this is the chart that I think will define the next coming months. When we get a rate cut, which we all expect to happen in September, 25 basis points is the normality here. Will we go up and go with the breadth thrust, or will we go down? The tracking of the next 3 months of structure for the S&P 500 in particular will be possibly the most important read for the future of the next 12 months. And we know that markets tend to track a very certain way when there's no recession over that 12-month period versus a recession that is impending. And it really does also come down to the rate of cut from the Fed. If the Fed go 25, then they go 50, or they go 50 straight away. Remember, 50 is a panic. 25 is a leisurely cut to help support a weakening economy. And markets can actually do okay over those periods. This is an interesting one because, of course, in the future, we've usually seen months before and after the first rate cut, some interesting sector rotations occur. In particular, you would think that maybe you would see sell-offs in certain markets. Well, actually, tech hasn't performed very well into the cuts predominantly, and it's actually done a little bit better after the first rate cuts. Now, I'd say this is heavily skewed by recession periods such as 2008 and, of course, the tech bust. So you've got to take this with a grain of salt, and we'll be breaking it down a little bit more as we enter into September, so make sure to watch across then. But this will be an important factor. And speaking of September, where do we see the worst results according to the market? Well, not only is the second half of September statistically bad, but it's also when we're going to get the rate cut, which we know usually brings a sell-off with it. And Wayne Whaley's data recently said that between September 23rd and October 2nd, we may see a mini pullback. In fact, the stats are kind of suggesting that it will be a bad time for markets. Earnings calendar for this week, still going on with earnings. Got Snow, Zoom, Target, and many others coming out, including Baidu. Bit of a up, down, and all around for the overall Chinese market over the last 24 hours. Walmart selling its stake in JD sent the market to, of course, fall off. But yeah, generally speaking, I would say a defensive day for market participants. Where did we see the growth? Well, growth was kind of middling to down, but look at this. Gold, staples, healthcare, REITs, all of the things that recently have been bullish or bullish during drops, they were the strongest sectors. Now, this is suggesting a defensive move from Wall Street leading into this resistance high. So as we've gone really, really strong, all of a sudden it went defensive over the last 24 hours into the Jackson Hole Symposium, into the data stats that we know suggest there are some weakness periods. Now, we don't have a trigger yet on the technical analysis side, but we do have a couple of other signs. One of those is the advanced decline line, and this, of course, has dropped off a little bit over the last 24 hours. So certainly a problem here when it comes to the market starting to see a little bit of weakness, filling those gaps, and will we get down to these levels? Well, one of the things I like to do is, of course, use a fib extension, and we'll just kind of go over here to the futures market and take a fib extension from the low all the way up to where we are in terms of the highs. And what you're going to notice is that that 5,300 level in particular seems to have quite a lot on it. It's got certain anchored VWAPs off the lows. So if we put an anchored VWAP on, you'll notice 53.28 becomes an important level. If we think about the fibs around this zone, a 50% fib. If we think about the gap fills, there's gap fills around here as well. So there is a real possibility that markets could do this and then still double dip back into September. Now, why could that happen? And more importantly, is it in the interests of Wall Street more so than anyone else? Well, do remember at this stage, the structure is bullish. Should you be worried as a longer term investor or position-based trader? I don't think so. And some of the reasons why is we're holding this strong trend of the 20 moving average, of course, on the 2 hour. Also on top of that, we haven't got a lower low. So we're still looking for weakness to come through at least the 20, if not break through the lower low, which currently sits at around 55.41. And there's just not that much kind of going on from the bear side just yet. We only have 1 day of defensive movement as well. So let's have a look at the options, and you'll notice that some puts came out of nowhere over the last 24 hours, particularly around 55.85, which is kind of where we find ourselves right now, 5,600 at the time of recording. So we know where the positive gamma switches to super bullish. That level is going to be 56.35, 56.20. So 56.20 plus to 35, markets are going to continue to rip and squeeze higher, at least based on the options. And at 55.85, there's a lot of puts that came out of nowhere. So someone's starting to go, maybe there's a little bit of downside here into the gaps. Maybe we actually have hit a peak. It's early days, but with defensive action by the markets, with a lot of call premium to be made by the Wall Street sellers, this is, of course, something we could consider. NASDAQ versus CTA positions. Remember, we know that CTAs have been caught not investing enough in the markets. They actually got caught flash selling just 2 weeks ago, and recently they've been trying to buy up. These guys are now underperforming the market for 2024, so they would like a gap fill, and maybe the market will try to get down there to allow them in. That's also another reason why markets have squeezed so high. Everyone's been clamoring to get back in after the VIX 65 event. Silver CTAs also increasing, gold CTAs holding neutral, and in general, most of the CTAs are kind of just all neutral or slightly up. But if we have a look here at NVDA, you'll notice the 130 is still too much for this stock. We warned of it in the last 24 hours. It's the biggest call this week. If options riders are trying to make a lot of money, they're going to try to hold it underneath 130. So this is what we call a call wall. It's a significant level and we must be paying attention. Brent CTAs have been dropping, which is going with price action. And of course, Tesla continues to try to hold above 220 and push towards the 228, 232 level. We'll take a look at that in just a moment. But Tesla's still in positive gamma at this stage. Consumer discretionary versus staples. As we go into the charts, you'll notice here we've got a decent amount of sideways action. And US 2-year versus 10-year yields, you'll notice again, they've been kind of picking up. So realistically, this is a pretty important factor here when we're taking a look at the charts. You'll notice that uninversion of yield certainly hasn't really been kind of a discussion that we've had to really have yet. We saw it for like a fraction of a second during the VIX 65 event. When we see it hold down for a couple of days, that will tell us we're on a timer towards, of course, a recession in the US. And we do need to be aware of that because a lot of people think it's a broken indicator. I don't think on this channel we think it's broken. I think it's a timer that we put on the markets from that point. And of course, we've been looking for it for quite some time. Treasuries continue to gain along with bonds, even though yields have kind of remained relatively flat. And this is again telling you that someone is deeming that we are entering into what I call later cycle investing. Now, that usually means that we're around 12 to 18 months away from something a little bit worse. Utilities tend to rise up, healthcare tends to do better, and that's actually a sector that sometimes does all right as well post a rate cut. It's also a late cycle investment, and if you want to put XLV and XLU on your charts, you'll be surprised. Dollar index continued to fall towards our level. We've been pretty clear on this. I think that we all think that the US dollar is weakening and that it's heading towards the 101s flat and maybe even parity, which is the 100 level. So at this stage, the US dollar continues to weaken. Copper held its own around the resistance. Not much to say there, but we have been bullish on copper over the last 2 weeks. And if we take a look at gold, it's continuing to grind higher at 25.17. The real standout, though, has been silver. Silver's been an amazing trade and really great risk reward. So well done to everybody that got this silver trade last week, that's been resilient into buying it. And of course, this was a great take profit zone. Now, because we've found ourselves here, and again, we're trying to close above the 29 kind of 50 area, if we do manage to do that, then pullbacks should be met with bull demand. So realistically, this is a pretty strong market. Silver's looking good, and I'm excited to kind of cover it over the next coming weeks and months. US oil, on the other hand, still struggling. If you go really short time frame, you can see it's trying to form a base around this bull zone for oil. I think it's too early to tell that this is a really good buy area for it, and oil remains really bearish. So we need to just kind of keep that in mind. When it comes to Tesla, had a good start to the session, got up to 228, which is kind of where those call options are. Didn't quite get 232, which I do expect on the price action. So I'd like to see Tesla kind of continue on. Is it the best trade ever? No, but I would like to see it finally bull up to 232. Maybe it's going to find some resistance there. Another one of the stocks that kind of, I would say didn't really perform fantastically over the last 24 hours. Intel had a good Monday session, not a great Tuesday session. Like to see this continue to pull up. And as we talked about, needs to hold now under this above this low. We don't really want it under 2040. Remember, this is not a good stock. It's just one of those ones similar to Crowd, similar to SMCI and some others that we've had falling off a cliff, and then they've looked and shown a replicable turnaround event. So I'd like to see this at 23, and I did actually track the options. If the market is able to go above 2150 and hold, that's where you get into a significant positive gamma event. So again, a lot of options sitting at 2150 for that particular stock. NVIDIA's found some resistance around 130, no surprises, tons of options sitting at that level, so we know that's a call wall. And HSI, the Chinese market, dropping with an island reversal backwards. after the JD news came out, but still holding where I would like it to hold. So it still had a bit of a bounce up. I would like to see it hold a green candle above 17,400, but things are still looking okay in China. Now you might say, well, the stats are terrible. Yeah, they're even coming in. If you can believe it, the government has announced that they want to use bonds, a bond program, to buy houses that aren't selling to help support the economy. Yeah, if that doesn't sound like a Ponzi, then nothing does. But at the same time, we've had this happen in Japan, and we've also had this happen in, of course, America to differing degrees. So it's that type of thing when the central banks get in it and they put the sovereignty of the country to try to hold it up, it does tend to bottom a market. Remember, they've gone through a recession, so there's nothing good coming out about news, but still the price action's improving. US 30 is at resistance. We do get our red stop sign on the US 30. That is a warning signal. It often means a little bit of weakness could be coming. You'll see over here, we got another read here. Some days of strength, then weakness. So what I'm thinking is even if the market goes up here a little bit, this is a warning sign that those two gaps, in particular for the S&P, are very much open for the markets to pull back down to. And I think it's one of those points where I wouldn't have too much FOMO in markets, even though things seem so great, because if you missed out on what we already were bullish on a few weeks ago, now is not the time to be thinking, wow, this is the best FOMO event I've ever seen. There's just not as many good bullish stats as we've had when it comes to the next week in particular. US 2000, nice, held up. Didn't do too well during the session, but again, held up okay. Looking towards 2250 ultimately for that. Of course, FactSet Tom Lee, FundStrat, he was loving IWM in a recent interview. Maybe we'll show that on the show in the next video and we'll go through IWM, but he certainly was loving it. Gap fill completed on the Qs. Again, little bit of down session here. First weakness in over 8 days. Will it lead into those more negative stats? 45% of the time, obviously only up over the next 5 sessions. Then it comes to Bitcoin. Bit of a flash sell here. A lot of people very negative on Bitcoin. Held the level that we talked about on the Monday stream. Obviously found some resistance around that kind of high here of 61.5 kind of area. If we get through 62, good times for Bitcoin. Should be going towards 68 at that point. But yeah, still looking bullish, still looking towards the upside here more than the downside. A lot of people super bearish on crypto, I've heard from many members in our private Masters Club. A lot of you guys are saying that heaps of people are bearish. I wouldn't say this is a super bearish looking chart. It just kind of looks like it could be distribution, but it does still look more like accumulation to me at this stage. And again, everything's about replication, so don't put all of your eggs in one basket. For the news for the week ahead, of course, there is still some more news. We've got Thursday, flash manufacturing PMI. We do have the FOMC meeting minutes coming on Wednesday, so that could move the market. And then we may get a little bit more information from Fed Chair Powell, though I've heard rumors that Fed Chair Powell believes or is not meant to be mentioning too much about what's going on in September. Another story you may have heard of is, of course, the ridiculous amount of jobs revisions. Just remember, the market already knew this, so jobs revisions were expected to be ridiculous, and this is why we don't trust the jobs numbers. Non-farm payrolls might be volatile, but doesn't mean we can trust it. Just a quick announcement, I will be talking at the FMPS conference next week, 27th to 29th. I'll be on the 29th. If you're interested in coming out and saying hello and checking out the speech, it'll be a good one, certainly worthwhile coming to. I think you'll get a lot of value out of it. That is free to, I believe, attend, and you can check out the links in the comment and pin description down below. Definitely sign up. It'll be great to see some of the Sydneyites out there from Australia. Also, if you're interested in anything else that we're doing here on the channel, make sure to subscribe, follow us on X, guys. And if you want to know more about replicable trade systems, definitely check out our day trading and, of course, advanced master course. Some amazing cyclical theories there, helping us to gain this clarity in an unclear situation, I guess, especially when it comes to the US election, post-US election, and heading into this late cycle period. Thanks so much. Catch you for now.